Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic I want to discuss with you short-term annuities and what is a short-term annuity and why that may be important for a specific situation. Now, when dealing with a lot of different retirement portfolios and setting up a lot of different retirement plans, we come into contact with some of those individuals that we've already accomplished their major income goal, meaning that, let's say this individual is age 60 or age 55 and they're looking to turn on their income. They're looking to pull out money from their 401k accounts, IRA accounts, cash accounts, whatever that is. We already show them ways and strategies how to successfully get from that point A to point B and then turn on that income and make sure that the income's coming to them for the rest of their life. We incorporate inflation, we incorporate different long-term care aspects, etc. Now, where short-term annuities come into effect is with the individual that, let's say, in this given scenario, this individual has $500,000 that's sitting in an IRA account, and based upon their income goal, all we needed to do was just leverage $350,000 of that. So now this other $150,000 is essentially sitting in cash. Well, some individuals say, I love the concept of an annuity. I like that whole concept of, either an index type aspect or a hybrid type aspect where the money could either grow whenever the market goes up or flatline whenever the market goes down, grow whenever the market goes up, flatline whenever the market goes down, or have a fixed type account, like a fixed annuity where you're just going to get a set interest rate year by year by year. But what the individual doesn't like is with some of these longer term annuities, you have your money has restrictions on it for within those first 10 years. Some companies do 12 years, some companies do 14 years. Typically, the ones that I like to deal with are either 10 or less. So that leaves a large gap there that this individual likes the annuity concept, but they do not want to place their money in an annuity for 10 consecutive years with this additional money for another 10 years. So this is where short-term annuities really come into play and can work successfully for a specific retirement portfolio. Now, one of the things that I try to do, or I at least try to educate my advisors on, is you want to try to leave the client's money as much cash as possible, as much liquid cash as possible. So in this situation, we were able to successfully get that client to receive their lifetime income streams, to utilize different laddering strategies based upon the hybrid annuities and based upon their income goal. And this individual still had $150,000 sitting there in cash. But this individual said, I don't want to just have this money sitting in cash. I want to use it into a very safe compound interest component that's for a short amount of time that I have more flexibility with. And this is where the short-term annuity comes into play. Out of this 150,000, this individual could take about 75,000 if they have that goal, leave $75,000 in pure cash, maybe utilize $75,000 to play around with in these short-term annuities. Now, rather than ramble on, let me explain to you what is a short-term annuity and what are two very attractive short-term annuities right now. You have a fixed index annuity. This is not a hybrid. We don't have an income rider on there. It's just a plain fixed index annuity. And then you also have ones that are just a fixed annuity. Okay? So with just the fixed annuity, this would probably help explain things regarding the fixed index annuity. With a fixed annuity, let's say if we took that $75,000, actually, you know what, we'll use $100,000 just for easy math. We took $100,000 and we threw it into a fixed annuity, and this was a 5-year fixed annuity. Fixed annuity kind of acts like a bank CD. It's kind of that same component where every single year you're going to be receiving a fixed interest credit year by year by year by year. The major difference is annuities can only be owned through insurance companies. They have certain regulations that they need to abide by on both a state and federal level. The bank CD has to be owned through a bank. An insurance company cannot own a bank CD, and a bank cannot offer an annuity. Sometimes banks offer annuities through insurance companies, and that's sometimes where you might see the confusion where you go into your everyday bank and they're saying, hey, listen, we have annuities at this rate. But essentially what this does is it would take your $100,000 and kind of think of it like a bucket of money, with a little bit of a lid over it. And let's say for a 5-year fixed annuity, you're getting paid 3%. So that means the first year you get $103,000. The next year it's going to be another 3%. The next year another 3%. The next year another 3%. And so forth. And then at the end of all those years, you would have X amount of thousands of dollars that you could either pull out completely or leave in there and allow it to grow and grow and grow. But this is going to be very liquid. And what's happening is, rather than a typical fixed annuity or fixed index annuity or hybrid annuity that's going to be about a 10-year product, 10-year restricted product, you have these flexibilities that you could just essentially walk away with all that interest that you gained. And they typically they pay out about 2 to 3 times higher than bank CDs of that same duration of time. So meaning a 5-year bank CD might be paying you 1%. A 5-year fixed annuity is typically going to be paying you about 3%. So just some different things, that understanding that you're going to be able to receive interest year by year by year. Some of them are flexible, where you could just live off the interest, live off the interest, live off the interest, and then still have your principal preserved and protected, and be able to walk away with full liquidity at the end of the 5 years. Now, sometimes you have fixed index annuities that are short term. Maybe you have a 6-year fixed index annuity or a 5-year fixed index annuity. And what this does is it has that aspect just kind of like a fixed account. But instead of paying you a fixed interest rate year by year by year, they're going to pay you an interest rate based upon an upward market index gain. What do I mean by that? Well, let's say you have a 5-year fixed annuity and you have a couple different options. Maybe one is a Dow Jones Industrial. Maybe you have one that's an S&P 500, one that's a Eurodex. And let's say you choose the S&P 500 one, and let's say you have a cap of 15%. This could say that in a given scenario, what they do is they take a snapshot, just like how at the end of every year your fixed annuity got paid out 3%, 3%, 3%. What they do is they say, okay, after 1 year, did this S&P 500 index, at the time that you place this contract in there, did this have a gain exactly 1 year, from anniversary date to anniversary date, from inception date to anniversary date? Was there a gain in the S&P 500? And let's say the S&P 500 gained 20%. Well, if you had that cap of 15%, then essentially you would have a 15% gain into your account, making your $100,000 go to $115,000. And it's going to ratchet in. The next year, from the anniversary date to now the new anniversary date, exactly 1 year, did that and let's say you kept in the S&P 500, did the S&P 500 go up? No, that year maybe the S&P 500 dropped 20%. Now, unlike other products where you would have full loss of 20% and really hurt your account, because that's an even larger number and a larger loss, what they do is they give you a floor of 0%. So in that scenario, because it was minus 20, they're not going to give you a negative 20 onto that account. They're just going to credit you 0%, meaning that now the new 115 is going to sit there. So rather than basically place your money into a fixed annuity that's still going to be a short-term annuity, the reason why individuals like to utilize the fixed index annuities is because it allows them to beat the pace of inflation, and allows them to gain on the power of compound interest. You have 1 good year off of, let's say if you had a 5-year product, you have 1 or 2 good years, you blow the doors off of a fixed annuity all day long. Now, maybe when interest rates increase, things are going to be a little bit different. But right now, interest rates are so low that the fixed index annuities are very, very attractive. And also, fixed index annuities, kind of how they have their caps, their spread rates, that's all tied to 10-year Treasury bonds as well. So even when fixed annuities, which individuals used to be able to leverage very easily for retirement income planning back in the day and just live off the interest, live off the interest, live off the interest, and just use a short-term fixed annuities, now you have these players of the fixed index annuities that are coming in there. Now, a couple of things that I want you to understand, because it's not just all rainbows and butterflies. With the fixed index annuity, the way that the company is able to give you a very high guarantee is not through fees necessarily. It's through the length of time that they hold your money. What do I mean by that? Well, let's say if you have a typical hybrid annuity that is a 10-year product. Now, that doesn't mean that you can't pull out your money. If you had a 10-year hybrid annuity product, you could still execute your income rider, within 30 days of when you set up the contract. You'd still have the power of compound interest on one side. On your actual physical money, you could have a specific guarantee through the insurance company that they're going to offer you on your actual income side and make sure that you receive lifetime income. And then you're going to have restricted liquidity, allowing you to pull up, or depending upon the product, allowing you to pull out 10% per year for up to the first 10 years, and then 100% full liquidity after that. Well, that's still, even though they're giving you up to 10% that you could pull out of your account value, this 10-year aspect is how the company's able to give you a very high contractual guarantee. Reason being is because they're saying, listen, this person is placing their money in there. We understand that they're not going to go place their money in there, receive premium bonuses, receive all these good credits, and then in year 3, this client's just going to pull out all their money. They have certain restrictions there, and they could hit you with surrender charges. So an individual that likes this concept of the gain, flatline, gain, flatline, gain, flatline, they could really gravitate towards the short-term annuities, the short-term fixed index annuities, where you could essentially leverage that 5-year product, that 6-year product, 8-year product, whatever it is, where after that time frame, you just walk away and you could roll it over into something else. You could either remain in that contract. It's entirely up to your choice at that point in time. But just understand, the less restrictions that the company gives you, typically the lower the cap is on your crediting options. Meaning that if you have a 10-year product, maybe your cap's going to be 20% off of a given year. As when you have a 5-year product, maybe your cap's going to be 8% on a given in a given year product. So there's always going to be some give and take, and there's no unbelievable product. There always has to be a caveat. There always has to be a catch to these annuity contracts, because the insurance company is not just going to be giving away free money and giving away all these guarantees. The amount of times that I have people call into the office and they say, okay, I want a product that pays me 8% guaranteed, and I want a product that is going to give me the most amount of income, and I could just pull my money out whenever I please. It's like, yeah, I mean, I really wish that someone just paid me, that I just won the freaking jackpot today, but it's not, it's just not attainable. It's not something that a company will never offer you that. And if they do, I would really question that company on giving you this specific high interest rate and giving you full liquidity on it, or very, very short term, such as like a 1-year product or a 2-year product with all those bells and whistles. It just does, the math does not add up. And that's what you have to do. You have to look at the leverage. Are you accomplishing your income goal? Are you accomplishing your safe accumulation goal? Are you making sure that you're beating the power of that you're beating the pace of inflation? Are you making sure that you're gaining with the power of compound interest? These are different aspects that short-term annuities could really help you out, and they typically pay a lot higher than the average bank CD, especially in today's times, where you still have a safety aspect, you still have a legal reserve structure, legal reserve system aspect, making sure that your money is very safe, preserved, protected at all times. So I know this video is a little bit lengthy. I really just felt it necessary and wanted to help explain some things. At any point in time, please give our 1-800 number a call. We have 24/7 customer service. We're here to help answer any of your questions. We could show you the best short-term annuities out there. We could show you the different fixed annuity rates. We could show you the fixed index annuity rates. Typically, those are the ones we deal with on a short-term basis, but just understand exactly that there always has to be a little bit of a catch with it, because a company is already reducing their restrictions. Therefore, they're going to have to take away some benefits that they would be offering you. So, but that's the most important thing. You cannot just go into this blindly. You have to make sure that you're educated. You have to make sure that you understand how these products work. And this is one of the reasons why we are A+ rated on the Better Business Bureau. We are accredited business, and we've never had complaints, and we've always had really good reviews. The reason being is because of our methodical process. Once again, this is Derek Afasi. I want to thank you very much for watching this video. Please subscribe to our YouTube channel, Retire Sharp, so you can get access to the most updated videos. Thanks, guys.